Hey guys, welcome back to the mentorship episode. Week second, and this is the episode first for the week second. And today we will be talking about the IRL to the ERL model. IRL to the ERL model. We will be talking about that, what that is, and how we use them in the trading, and how can actually we simplify our trading using only this IRL to ERL model. So let me get you through. So all we know is market moves from the liquidity to the liquidity. So market is moving from the sell stops to the buy stops. Example here I will just giving you. So here is a market coming up and it is just moving like this. So example, there is a equal lows presented right over here. So what market will do, market will take them out. So these lows are called sell stops, and it will go higher to take out these buy stops. So market will go higher like this and take out these buy stops. So market is just doing like this in the every moment. So today we will be talking about the internal liquidity to the external liquidity. So we all know this market is moving like this. It is not a clear picture of how the market moves, but this is an example how the market moves in a very straight way. So in the from the low, so this is a buy side liquidity, and this is a sorry sorry, this is a sell side liquidity and this is a buy side liquidity, because these are the stop loss of the sell side. So the sell side stop loss is equal to buy stops. The buy side stop loss is called the sell stop. So market is moving like this. So between whole this range there are like gaps, imbalances present in this range, which I call the IRL, which is called as a internal liquidity. So market is moving from these uh, ranges. Market is moving from these highs to lows, coming down to the IRL area and then going to the higher area. So this is a perfect example how the market moves. So how we utilize this thing in our trading, let me tell you in the next slide. So in this short example, we can see this is a daily time frame for the GBP USD, and these are the sell stops and these are the buy stops resting above all this area. And between this area, we can see the fair value cap presented in this area, and we are expecting price to react from this area and to go higher. But if you see right over here, price is going lower. So there are some chances when there is a fair value gap presented in the lower time frame also. But we will take the example of daily time frame, and we are expecting price to go higher from this area. How we will do that? We will go to the lower time frame and wait for the confirmation. But for this lesson, for this chapter, our main focus is to goal upon. Our main goal is to understand the internal liquidity to the external liquidity. So this is the external liquidity is presented right over here in the uh, form of what, in the form of sell stops which are right over here, and the buy stops which are presented right over here, and price is moving up this range. This gap you see between these highs and lows, it is called the internal liquidity. When price reaches to this area, we are expecting price to bounce back from this area and to go higher to up to these areas. So this is a classic example of how the market is going from the internal liquidity to the external liquidity. So I will go back in the time and see other examples. So here is the examples. Price has created a range. So this was the low and this was the high. So price did what? Price came to up to this area, retraces down, came up to this fair value cap area which is presented right over here. Then it started to move higher, take out this high. Then in the next example, price go higher, left out this fair value gap area which is right over here, and then it go higher. So this is an example of how these all things are working and how we can use this thing in that trading. This is the example of IRL to ERL example. So how the price is moving from the internal liquidity which is right over here, the price is reacting from this area, bouncing it back and going higher. So let me show you in the lower time frame. All these things are also working in the lower time frame. Let me go through that. We'll just use the replay chart for the better instances, and we are in the daily time frame, and we will go to the 1 hour time frame for the time frame alignment. Our range liquidity is right over here. I will wait for price to go up to that area. Okay, here's a new day opening. There's a gap between the price and now price is going lower. Okay, price has come up to this area. This is a gap area, and if we are expecting price to move higher, so if we are expecting price to move higher, we should close above this area. First, if price is not taken out this low, we will be expecting price to take out this high. But for this example, price is taken out this low again. Now we will expect price to come up to this area and take higher and go higher. We will see that is there any displacement? Yeah, this is a displacement. And does the price take high? Yeah, price take high. Now from where we can go long? So we can use this example, which is right over here. We can use this example from this and low to this high. So you know the fair value gap, the internal liquidity is from the high of the previous candle and the low of the next candle. The between the gap is called the fair value gap, or we call it internal liquidity. So here we got the shift right over here. If we want to buy, we will buy from this area. Our stop would be at this low, and we will be targeting the 2 hour. Yes, this is the example. But if I wait, I will wait for another CSID to form. I would wait for what price to came up to this area and then go higher. So I would wait for that. So here is the example. Price is going lower. Is rejection. Okay, it is getting rejected from the. It is rejected from this area. Now I will wait for what price to close above this area. So let's wait for that. Okay, here we got a rejection coming up. Nice rejection. Nice volume coming up. And actually we're out of the session. This is, you can see we are in the Asian session now. This is creating a range. This is a range currently we are in. I will talk about these topics after. So here is the example. I would wait for price to sweep out these highs, or directly close above this area, or just sweep out this low and go higher. So I will wait for that and see how what happens next. Now this is not a change state. This is not a thing which we are looking forward to. If we are waiting for the price, we are waiting for price to close above that level. So does it close above this level? The answer is no, it is still not closed above that level. I am waiting for price to close above this level. So let's wait for that. So we are in the new day opening and we are about to close. No, we did not close yet. No, we did not close. Okay, in this example, we have closed above this area. Now we can take our buys. Our buy would be right over here. After the closing, we should wait for the retest of this level. If not, we can adjust the market price. I will wait for that area. My stop would be below this low, this low, and I am targeting what? I am targeting the high. So I am targeting 1 to 2 hour. I can use this as my target. So yeah, this is a liquidity area presented right over here. I can use this area for targets, and let's see how it plays out. See, this is a perfect example I am just giving you. Here is a liquidity sweep happening right over here. The CSID happening first right over here, and the second CSID happening this area. Retesting buy, and one is to 2.5 risk to reward. This is an example of how price is going from the IRL to the ERL. I hope you like this video.